Afternoon.
Okay, greetings from Seoul, and welcome to today's special event, as we'll have a discussion on important issues in big tech, regulation, and banking industry. Due to the current COVID-19 situation, today's talk will be conducted online. For today's event, it's a great pleasure to introduce our distinguished guest speaker, Professor Thorsten Beck. Professor Beck has been a professor of finance at Cass Business School since 2013. Before joining Cass, he worked at World Bank and also Tilburg University. He has provided professional consultancies to many institutions. The World Bank, European Commission, European Central Bank, and Bank of England, just to name a few. Today, he will share his insights for about 20 minutes on recent developments of big tech in EU and policy implications of big tech. Then we'll proceed to a Q&A session on big tech with Professor Beck and our panel here at the KIF. And I'll take questions from our panel. Okay, Professor Beck, whenever you're ready.
Great, thank you very much. Good afternoon to everybody. So I was given a couple of specific questions and I kind of would like to go through them, maybe as a start before we go into the discussion. So there were some specific questions on recent regulations in the European Union. One refers to the Payment Services Directive number 2 from a few years ago that kind of had the goal to increase consumer protection, but also to create like a single market in payment services across the EU. And of course, like many who live here, I've had personal experience of that. But of course, it's also good to look at it from the broader picture of how this will affect the financial sector going forward, especially as the question goes, how will that impact the relationships between banks and non-banks, or specifically big techs? So the question that was put, that Professor Park forwarded to me was, will the introduction of PSD2 increase the market power of big techs in Europe? Implementing the PSD2 has raised the concerns that in the absence of any regulatory intervention, big techs are likely to take advantage of open banking to get a competitive edge in the provision of various financial services, in particular in the retail banking platforms. So I assume that this refers mostly to the issue of open banking, in the sense that banking data, that banks are forced to share customer data if the customer agrees with other banks, but also with other non-banks. The other way around is not the case. So big techs, for example, are not forced to share their data even if the customer agrees with other providers. And yes, on the first look, and I think I mentioned this also a few weeks ago in my presentation, this creates a kind of a bias for the in favor of the big techs and against the banking system. Now one has, of course, to see that this is important, although it's primarily for payment data, as I understand. And I would argue, firstly, that the big data advantage of big tech companies goes far beyond this one specific segment of data, payment data. So the advantage of big tech, of course, more generally, is that they work with, or they have access to and can work with and can process customer data from across many different markets. I mean, in some cases, let's say Uber, for example, it is all about transportation data. In case of Facebook, it's all about social media. But often these different platforms, of course, kind of reach out or are active across different markets. So they collect quite some different data, which can then be cross-checked and can be multiplied. Basically, the impact can be multiplied in terms of their use in assessing, for example, clients' insurance worthiness, credit worthiness, wealth assessment and so on. So I would say in the first instance, and maybe I kind of spoke a bit too quickly a few weeks ago, yes, it is important. It does create an uncompetitive advantage for big techs, but I think also that the advantage of big techs goes far beyond that. Now, one has to also look a bit more generally at the role of big tech companies currently in the European Union. So I think one can say that big tech companies are a bit in the hot water right now here in the EU for different reasons than they are in the US. In the US, it's a lot about politics. Here in the European Union, there are a lot of concerns with respect to these platform companies in terms of their competitive position, so having monopoly positions, even if temporary, and of course, taxation. So the fact that most of these digital platform companies pay little, if any, tax, or if they are forced to pay tax within the EU, then their subsidiary is typically based in a country, let's say, for example, like Ireland, which is a low tax environment. There's a third one, of course, for part of the platform companies such as Uber, which is related to the gig economy and to labor market regulations in terms of whether they're employees or independent contractors, but that's a bit aside. But so, but maybe it's not too aside, because again, in political terms, big techs are not the favorite part of the corporate sector right now, both within the public, but also especially within policymakers and regulators. So I think the movements, that if I want to say so, the movements of big tech companies or platform companies in general will be carefully watched in the European Union, and especially if a broader expansion into the financial service side will probably be watched by different authorities, most prominently the competition authority in Brussels, so the Director General for competition, in terms of ensuring that they do not, let's say, abuse their market power, or in generally get a market position that is too strong and might endanger competition. So that's kind of my first point. And that's, so again, this is purely from the viewpoint of competition, and mostly in terms of payment services. Of course, there are the other areas, credit services or intermediation services more generally. I'm going to come to that maybe at a later point. So then the next kind of going actually on from there to more specific regulation within the financial sector. And as I mentioned earlier, there are broader concerns, competition, taxation, but then there's a third concern, which I haven't mentioned so far, which is data protection. So there's the GDPR, General Directive on personal data, I think, enforcement in, and that, again, has brought some of these platform companies in quite hot water with the European Union, because there are concerns. There is a now strong protection in terms of the transfer, for example, of data from within the EU to outside the EU. Big platform firms are forced to have their data within the EU, and have to also very clear protocols in place to protect these data. And of course, there is the issue that any customer has the right to know what the company does with its data, how it processes them, and can actually also ask a company to forget its data. Now, again, this is a much broader regulation, far beyond the financial sector. But of course, it also affects the financial sector, because it puts a certain limit, two limits. One is, of course, that these large big tech companies that have lots of data, that rely lots of data, can easily enter the financial sector, because they are subject to the same kind of data protection framework. But of course, one can also argue that, and this is the last question, that it might prevent the entry of new financial service providers, smaller providers, or it might endanger the market position of smaller providers, because implementing these the regulation under GDPR implies quite a heavy fixed cost. So that's more generally. And then, of course, if these big techs will start expanding into the financial service area, this will attract actually the attention of two types of authorities. One is the competition authorities, and the other one is the prudential authorities. And as you might know, at least within the, well, there is a single supervisor now within the euro area. Well, euro area plus two, Bulgaria and Romania have now also joined the banking union in advance of actually joining the euro in a couple of years. But there is the option, although it's not an easy one, it would have to be done partly through legislative measures, to take on additional significant institution, or to declare certain institutions significant and put them therefore directly under the supervision of the ECB, if it is esteemed that their activities within the financial sector are of systemic importance. So this could mean that even if you have let's say one of these big tech companies goes into financial service provision through a subsidiary, for example, or by purchasing a bank, or directly, which I find rather unlikely, this might actually, given the overall size of the big tech, not the subsidiary financial service provision, but the overall size, might make it a significant financial institution. We had a similar case of like 10 years ago, of course, in the US with General Electric, which ultimately then sold its credit card and its car financing company to kind of get rid of the status. So this is one way to handle this, basically, that if big techs go into this financial service area, that you can basically hit them with the big stick and say, well, you're subject to prudential regulation, and not just to regular prudential regulation, but actually to the prudential regulation of a significant institution. Of course, before it gets there, one important point will be that if a big tech goes into financial service provision, it might be forced to do this through a subsidiary with firewalls. So two things here. One would be like a regulatory ring fence, like we have it here in the UK, where certain parts of the banking sector have to be standalone, in the sense they have to have their own capital, fulfill their own capital requirements and also liquidity requirements. The other one would be also kind of firewalls, in the sense of that data sharing, for example, or sharing of other information joint services is subject to certain restrictions. To basically make sure that any problem that arises in the large or big tech company won't affect the financial service provision in the subsidiary. So certain firewalls, certain restrictions within the business, between non-financial and financial, but also between the global and then the EU-based part, is certainly a measure that could be considered to kind of both from competition viewpoint, so to avoid a level playing field, but also, and as importantly, I would argue, for prudential reasons, to prevent that there are contagion effects. So the third point is the overall competitive structure. And I understand this question a bit broader, in the sense that it's not just about big tech, but it's about small players in general. Again, as a background, as maybe you know, the European Union, or different countries in the European Union, have very diverse banking systems, where often you have a couple of large players, but you also have a large number of smaller players. You have cooperative banks, you have savings bank, which are active on the local level. You have niche banks that focus on specific sectors or on specific products. So the question is, will these kind of regulation actually weaken competition, in the sense that they undermine the market position of smaller players, both existing smaller players, but also, for example, smaller fintech players that might want to enter the market. And of course, as a background, yes, any new regulation, and again, if the European Union does a regulation, it's typically a big regulation, attracts certain fixed costs. And of course, these fixed costs are much easier to bear, let's say, for large banks or for a big tech company or for a large platform company, or large fintech, than they are for a smaller player, be it startups or be it existing incumbent, weak, small banks. There is a counter effect that should be taken into account, and that is that the digital single market, of course, allows new entrants in much larger scale. So if you are a small startup, let's say in Estonia or in Latvia, which is an incredibly small market, which is actually also dominated by a couple of large banks in each country, then you can actually easily expand your, or can offer your financial services across 27 countries in the European Union, actually 30 countries in the single market, including Norway and Iceland and Liechtenstein. Which also means that if you go, and again, the advantage of fintech, of course, is to have high initial fixed costs, but then very low variable costs, so you can go big from the beginning. So that's maybe a counter argument to be taken into account, that the initial entry, the hurdle barrier might be higher, but then a quick expansion is much easier because you have the scale of the digital single market. Now, one important point I would like you to take into account is that even if we take it as a given that maybe smaller players are being crowded out, and there's a lot of arguments a lot of discussions in Europe that we should actually reduce the number of banks in Europe, that we need consolidation because of the inefficiencies in the financial system, in the banking system in Europe. Even if you go to fewer banks, larger banks, within the single market, not within necessarily a country, but within the single market, this does not necessarily imply less competition. Because if these large players directly compete with each other, rather than being active in only one country or only being active in one market segment, this actually might increase competition. So there is not a clear linear mapping between market structure and competition. I think that's the important point I want to make here. And maybe finally, even if you have the situation where smaller banks might be disadvantaged, and I gave you some arguments of why this might not be the case, even if smaller players are disadvantaged in the broader market, they might be able to move towards certain niches. Which brings me to the larger point on what will be the future of banks. I mean, even if you think of a world where big tech, fintech, or some combination, maybe together with some banks, take over large parts of standardized, easily standardized parts of the banking system, let's say consumer credits, mortgage credits, payment services, maybe wealth management for middle class, investment advice. Even then, there might be still a market which is of products, client services that is heavily relationship based, which is custom made. The corporate markets, parts of the SME market, parts of the top end wealth management part. So I think there, I mean, again, there are different scenarios which we can discuss. And even in a scenario where you would see a broad entry of non-banks into the financial system, there might still be a significant market segment left for the banks to be profitable and to continue playing an important role in the economy. So, so these were the three questions that would be put forward to me. Maybe let me stop here, stop sharing, and then start the discussion and take any questions that you might have. Thank you.
Okay, thank you, Professor Beck. we'll have another 20-minute Q&A session, or like a panel discussion, if you will. So let me just let our panel here at the KIF take it from here.
Good morning, Professor Beck. Thank you very much for sharing your thought about the changes of market structure initiated by big tech in expansion into the financial services sector. I would like to ask you a question about the so-called competition fragility hypothesis or competition stability trade-off theory in the banking sector. Contrary to the concern that the big tech, the firms may impede market competition, there are also concerns about the financial stability. I think the two scenarios are possible. Number one, a big tech firm's expansion into financial services itself can increase the degree of competition or contestability in the banking sector. This will squeeze the margin of the incumbent banks, often by big techs providing outrageous benefits to maximize their own network externality. Number two, fierce competition on the platform may lead to excessive risk-taking activities by incumbent financial institutions and might ultimately hurt financial stability. In other words, big tech firms may make banks compete with one another because a few online platforms hold a dominant competitive position over service providers. So I'm more interested in this second case. So my question is, do you think that regulators should deploy a certain policy initiative to keep the degree of competition at bay or at a certain level on the platform for the purpose of maintaining financial stability? If so, what kind of regulatory approach should be taken to keep the competition at a certain level? Do you know any of such regulatory efforts as an example? That's my questions.
Yes, thank you very much. These are excellent questions, and I'm not sure I have the complete answer to that. I agree that just to come back on what you started out talking about, the competition fragility, competition stability hypotheses. Yes, I mean, you could see, for example, if big tech enter the financial service provision market or financial service market, that this might undermine the franchise value of banks, and therefore banks then start taking aggressive risks. And I mean, that's on the other hand, of course, you have the contestability, you have diversification arguments of why actually the entry of big techs might actually be good for stability. So there are different options, different hypotheses, which ultimately we don't quite know the answer to. And I think both are very valid. Both, I would say, are very much endogenous to what regulators will do. So how will regulators react, for example, if big techs enter the financial service area? Will they regulate? Will they make sure there's a level playing field, for example? Will they also ensure that banks cannot react by taking aggressive risks? I think one of the issues will be to look carefully at the incentive structure, both for big techs and for banks in their lending approach, for example. So these are a kind of important question. Now, in terms of should regulators try to keep a certain level of competition? I think that's a very difficult task, to have competition as kind of a policy target variable, or generally market structure. And I don't think there is much expertise, or not expertise, sorry, there is not much arguments to say that regulators are actually able to target, let's say, a certain market structure or a certain degree of competition. You can kind of reinforce contestability, right? For example, by having not too high barriers for new entry, by ensuring a level playing field. That's on the contestability side. But this doesn't imply that there will be entry and that there will be ultimately the outcome of a certain market structure. So I think targeting a certain level of competition will be very hard. I think what should be done is, again, contestability, make sure there are level playing fields, and make sure the regulation is not according to the name, but according to both the product services that are being offered and according to the risk that each of the players are posing to the financial system. I think that would be the main approach. And again, I kind of answered the question both from the side of the competition authorities, but also from the side of the prudential authority who care about stability. Again, I think from the viewpoint of specifically the prudential authority, it is really about the stability. It is not about a specific competitive structure. Again, coming back to my earlier argument, that a specific structure, let's say also a specific market structure, does not necessarily translate into a specific level of competition, and a specific level of competition might not necessarily translate into a specific level of risk in the economy, in the financial system. It interacts importantly with the regulatory system. You can have a very high level competitive environment, but you still can focus on the incentives, for example, of not pushing out aggressively volume-based, let's say volume-based incentive to push out loans. That you can still have competition, but not as much risk-taking. Or you can have very high competition, but where banks, just like in the US in the mid-2000s, push out loans at a high volume because that's how they incentivize their loan officer. So it's really the interaction between competition, regulatory framework, maybe also governance structure that affects ultimately risk-taking. I think the regulators have a hard time targeting competition market structure. They have a much easier time targeting regulation and maybe the governance structure within financial institutions.
Thank you. Okay, any more questions from our panel? Hi, Professor Beck from KF Consulting. It's the second time to meet you. It's a very great pleasure to meet you again. But my question is actually, you said a very quite difficult answers in the sense your big tech should be regulated as a sci-fi in a sense because they're expanding financial services in various areas. But the question is how you can regulate this big tech specifically for the financial services, because even if a big tech doing a lot of financial intermediations directly or indirectly, but it's very difficult to define the finance function, what they really doing, because even if they provide some kind of advertisement or comparison of prices, or sometimes they're having a very linked products, but certainly we don't know what they do. There's a lot of ambiguities, and so what we should do in terms of financial service, because Europe probably has taken very general approaches like consumer protections or data protection or some kind of like a data services market act. So, but in the financial industry, probably have to consider some more specific role of the finance industry has done up to now. So, what kind of aspect we have to focus on, and if actually we want to regulate these financial services done by the big techs in the future. Thank you.
Thank you very much for this. So, first of all, I think I'm not sure whether Europe is always the best example for everything. I mean, that's, I mean, if I just may point to Wirecard, which you certainly have heard about. Now, that's another big tech, obviously, but it is a big player. And it was a big player in the payment service area. It was called more like, I guess, a fintech, you would call it. And that went terribly wrong, mainly because the German supervisor did a horrible job. which has a little bit to do with the way German authorities supervise not just actually these fintechs, but also other financial institutions, sometimes even banks, in the sense they outsource actually supervision, which might not be the best approach. So that's just starting with that. In terms of, I mean, I think the question that you pose is a very good one, in the sense what do they actually do? And I think that would actually be the first question to be asked if for a regulatory authority concerned about the work or the involvement of big tech in the financial system, and then also the potential risk posed by these big tech companies. And I think the first thing is really to find out what are they actually doing. And I mean, of course, they might not tell you if you ask them, but there are ways to see also whether they are linked somehow to regulated banks, right? There might be linkages. And I mean, that's the one issue that we faced 10 years ago when we started talking about shadow banks, that these banks were in a shadow, but you could start seeing, or you could pick up the loose ends by looking actually at the banking system. Because the problem of the shadow banking system is not per se that they are there, but that they are linked to the banking system. And that makes it, of course, then risky, because any shock to the shadow banking system then propagates back into the banking system. Similarly, if you have big tech linked to the regulated financial system, then there might be risks coming from the big tech area into the banking system. So that's number one, kind of see the linkages between big techs and the existing financial system. And I guess the other step is then to see whether there are any standalone products offered by these big tech companies. And I think that's partly related to market intelligence. Yeah, well, I guess this is market intelligence, exactly, to find out what are they actually doing, what are they offering. Number two, or number three actually now, is of course a licensing regime, where if big techs go into financial service provision, they need licenses to do that. If they have not done it so far, then they should be forced to do it, even if they just do payment services, for example. Even if they do only consumer credit and it's maybe just a deferred payment, they call it deferred payment or so, right? So there are ways, I mean, the issue, again, this is a general challenge for regulators, is that things might not be called credit or finance, but it's still credit or finance, even if it's done under a different kind of name. So I think the issue is that to force big techs to get the license, have a clear institutional corporate structure if they want to go into this area. And again, even if starting from the very simple one, not even going to intermediation, payment, just let's say savings products, or separately credit products, that they are under, that they are subject to the relevant regulatory framework, which again might not be the same as the banks, if they're not directly in intermediation and maturity transformation. But and then the relevant regulatory framework, be it purely consumer protection, or be it also on the more prudential side. So I think these are the three things I would point to. Number one, the linkages of big tech within the banking system. Number two, try to find out, are these big techs by themselves currently offering any financial services? Number three, if so, yes, then force them to get the relevant license. And of course, this license then also comes with data provision. They have to provide information, which then allows, of course, the regulator to learn about the activities and then to consider next step. So I think it's a constant kind of game, if you want, so between these companies and the regulators, where the regulator has to basically react to what big techs are doing. Big techs then react to what regulators doing, and so on. So it's a bit of a catch up, but it also kind of involves or requires a very kind of dynamic or adaptive, flexible approach by regulators.
Thanks very much.
Okay, hopefully we have just enough time for one last question.
Good morning. I'm Hyungjin Kwon from Korea Institute of Finance. Actually, I have a couple of questions about your last point from the previous discussion, such as about the entry regulation for the big tech companies. So, in a broad terms, I would like to ask you about your view on the separation of commerce, or in this case, big tech and banking. So many countries like the USA or South Korea still have strict regulatory approaches about the separation of commerce and banking, with formal rules on who can control banks and what companies banks can control. In those companies, big tech companies will not be able to actively engage in financial intermediation or maturity transformation, but they can provide like limited financial services such as payment services or lending on their own capital in the near future. But I think that despite the regulatory approaches, it seems inevitable that greater influence by big tech companies on credit provision or financial intermediation or maturity transformation is inevitable by the form of outsourcing credit scoring or by the form of providing like consumer channels. So considering this, do you think it is still desirable to maintain the separation of commerce and banking in the big tech like era? And the second question is, if the regulators in those countries lower the bar for the separation, what would be the risks or factors they have to consider when they allow big tech companies to own or control banks? And the third question is that even if the bar is not lowered, should we think that the accepting funds for like payment services be equivalent to accepting deposit by the banks? So those three questions. So I was wondering about your opinions on those three questions.
Thank you very much. Sorry, let me just go one by one. So yes, I mean, there are different approaches. As you said correctly, in the US, there is this restriction between separation between commerce and banks. That's why I think the Walmart never got the banking license, and that's why big tech companies typically have to link with a arm's length with a bank, for example, processing their payments or any other financial services that they might have. So not a standalone subsidiary, but actually an arm's length financial institution, often a bank that already exists. Now, doing so, of course, whereas in Europe mostly this separation doesn't really exist. From which there are big risks. I mean, I can tell you, I mean, it's a bit separate from the topic we're discussing here. I've done some work on a Portuguese bank, Banco Espírito Santo, that failed in 2014. And it failed basically because it was part of a larger corporate group. And there were big losses in the larger corporate group, the Grupo Espírito Santo, and that ultimately brought down the bank. The bank itself was actually doing very well, but it was then brought down by the rest of the corporate group. And of course, that would be the concern if you have a big tech company owning a fully owned or even majority-owned subsidiary, where then it's a risk coming from the big tech into the financial service provider. So I think there is something to be said about the separation. You can also think about arguments against it. I mean, you can still have knockover effects that go from the big tech company into the bank they're using, if either the big tech company has a critical role for this for this bank, and the bank in turn has a very important role within the financial system. So there might be a chain reaction that ultimately ignores the separation of commerce and banking, and ultimately there is a spillover effect. So I don't think that the separation of commerce and banking is really a complete protection against these kind of risks. And you can also say on the downside, it basically prevents the supervisor from ever getting insights into the commercial part of this relationship, for example, of the big tech company, because it is an arm's length relationship between the bank and the big tech. The regulator has no business of ever looking at the big tech company. So even if she suspects that there might be something going on, or there might be risks arising from the big tech. So that's I don't see that this protection, the separation of commerce and banks might give you kind of a false feeling of security which might not exist. You might also actually, the other possibility that has been mentioned is that a corporation, or this might force, or that might push, not force, it might incentivize big tech companies and banks to cooperate in a way that is actually also creating risk. So I think I mentioned this a few weeks ago. Take the possibility that banks offer their balance sheet, so their funding, their regulatory privilege of being able to issue, to intermediate funds and to issue loans, whereas the big tech company offers the platform to attract customers and to screen customers. Where is the who has the incentive to take risks? Where's the how are the incentives aligned? The big tech company might have the incentive to process, to attract as many customers as possible, to process as many loans as possible, if its compensation is purely based on loan volume, and the risk would end up in the banking system, because the screening monitoring takes part on the platform, but not on the within the bank. But the risk is on bank's balance sheet. So you have the incentive to risk taking outside the regulatory perimeter. You have the risks inside the regulatory perimeter. And again, you have a regulator that doesn't really have any insights into the incentives of the lending decision, and that's that would be a big concern. I mean, we saw something similarly during the global financial, the run-up in the global financial crisis in the US, also linked to to secularization. So again, it's another argument of why there might be a false sense of security if you just separate them completely. Now, if you say don't separate them, allow them, then of course the issue is, well, what is the relationship? How should big tech be allowed to enter the financial system? And as I made the case earlier, at a minimum you need a standalone firewalled subsidiary, even if it's majority owned by or fully owned by the big tech company. But even that would not protect the financial system completely, because I mean, as I mentioned in the example earlier, this firewall might not work completely. There might be still risk spillovers from the non-regulated big tech to the regulated subsidiaries. There might also be issues of losses, again, losses spilling over from the big tech company into the subsidiaries. And there might be also similar incentive problems, as I mentioned earlier, in the case of completely separate banks and big tech companies. So again, this is not a complete foolproof solution to allow big techs just to set up a subsidiary. So I think the challenge will be that even if we go beyond, if you get rid of separation of banking and commerce, so if you allow big techs to go into financial service provision, even if it's regulated, there is the issue of consolidated supervision. There's also the issue of coordination across countries, because as we know, these big tech companies are often global companies, even if they are officially, formally have a headquarters in one country. So the third question is on the funding. And that's a bit of so I've looked into this question in a very different context. And that is, as you might know, in Africa, in some countries, most prominently Kenya, the mobile network operators, in this case it was Vodafone or Safaricom, offered a mobile money account independent from banks. So where you could basically undertake payment services from mobile phone to mobile phone without necessarily having a bank account. Now, of course, this implies that there's a lot of cash flow for this mobile money operator, for this mobile network operator, and that money ultimately had to be held, or this was the decision of the supervisor, in the form of an escrow account within the banking system, which is so kind of arm's length. Not to be mixed with the Vodafone accounts themselves of the company with the same banks, and also distributed across different banks and not just one operator. By the way, also not subject to deposit insurance, which would have been the other big question mark that arose from that. So having funding for payments does not necessarily imply that these have to be considered deposits if they are being held within a regulated bank. Again, the important question is, what is the relationship between the MNO and the bank? There shouldn't be any ownership link, right? It should be, again, arm's length. It should be independent entities where the MNO basically has an escrow account in the bank and there's no other obvious connection between the two. Again, this assumes that this, if you take the case now from the MNO to any big tech, that the big tech only offers payment services and doesn't do anything else with either with this money, or if it does anything else, and it's, again, let's say credit or savings, then it's completely separate from this this payment offer. Now, again, in the case this was done in Kenya, is that this was kind of very much ad hoc solution, and the regulatory framework then later catched up with it. Of course, given that we have this experience, nowadays you would consider, of course, only allowing a big tech company to enter this kind of space with a payment license. And then these questions would have to be basically settled beforehand in terms of how to treat this funding. The good news is that this experience is now there and can be used to kind of decide on this question. Let me stop here. See if there are any follow-up questions.
Thank you.
Thanks very much.
Can I ask a simple question?
Yes, there's a bit of an echo though.
Yeah, you mentioned about the license platform of big tech companies as a final company. Do you think is it possible or easy for them to get a license in the UK or in the EU area?
Sorry, I'm not quite sure I understood. There's a bit of an echo in the line. So you're saying, do you think it's easy for them, for a big tech, to get a license in
as
UK?
A financial company. License, yeah, big tech company as a license of big tech company as a financial company.
Well, yes. I mean, they are getting licenses. I think even Uber has now got a license. So it is possible for them. But again, so far as I understand, so far it's only limited licenses. It's only payment service licenses. I don't think there are full banking licenses, to my best knowledge.
Only payments.
Yeah, that's my understanding. But I'm not 100% sure. But that's and again, there is. I mean, I know for the UK there is now a regime in place where it is actually relatively easy to get a kind of a fintech license for specific services, for example, for payment services.
And today you raised several concerns about big tech companies. Then how about regulatory authorities' preparations currently in the UK area, in the EU area?
Well, there are discussions going on. I mean, I can tell you, I'm part of the Advisory Scientific Council at the committee at the European Systemic Risk Board, which is kind of an EU-level macroprudential authority. And this is one of the topics we're looking at right now. So what should be the response of regulators to the to kind of a competitive threat? And I don't want to, threat is not a negative sense in this case, negative annotation by the big tech companies. So yes, there are lots of different initiatives, I would argue, across regulatory authorities to kind of look into this area. Of course, there has been, I mean, as you know, there is Libra proposal by Facebook that has been also looked at by different regulatory authorities. There is a big initiative at the BIS in Basel, for example. Of course, that's beyond Europe. That's much broader, where of course the Bank of Korea is also a part of. So yes, no, I think this is these are topics that are being discussed. They're not necessarily the top of the agenda, and of course, with the current crisis, they won't be kind of headline catching initiatives. But definitely on the staff level and on the mid-level, there are constant discussions on this issue.
Thank you.
Okay, I guess time's up, so we'll wrap up here. I'm sure it was a fruitful discussion for everyone. And again, Professor Beck, it was a great pleasure, and thank you for being with us today.
Thank you very much. A pleasure. If there are any follow-up questions, you can also send them by email. Thank you very much.
Thank you. Thank you.